Hello, this is Brad Harvey with Harvey Investment Management, and today is Thursday, March the 12th, 2020. Today will go down in history as one of the worst days that the market has seen in terms of total point loss, but there are other things going on today that are very, very important. And what's going on certainly requires everyone's attention so that we make decisions affirmatively and without having an emotional response if possible. Today correlations all increased. What does that mean? It means that stocks, bonds, commodities, all of those things tended to go down together. In fact, yes, the stock market has certainly had a precipitous decline over the last 3 weeks, but just in the last week we've seen investment grade corporate bonds going down dramatically. We've seen gold going down, we've seen oil going down, along with the stock market. What does that mean? Well, I will tell you that I've been in this business for 25 years. This is a time of great stress. It actually reminds me right now of what we were experiencing in the first quarter of 2009. Now, that's not a good history lesson. That was at the tail end of the bear market of 2008. But this decline also seems to be without reason. I will tell you that today seemed to be a little bit of an exhaustive sell-off. What does that mean? Well, it means we're probably nearer to a bottom than we are to a top. This doesn't mean that the market can't take another leg down, because it certainly can, but we want to be paying very close attention and focusing on the numbers and our exposure overall, because when correlations increase, that means that all risk rears its ugly head. So let me share a couple of numbers with you. Just 3 weeks ago, the intraday high on the Dow Jones Industrial Average, which is 30 companies based in the United States, was 29,568 during the day, what we call an intraday basis. Today, that same index actually closed at 21,200, and the low for today was 21,154. That's pretty serious in the whole scheme of things. That's a little over 28% decline from the top to the bottom. It wasn't quite as bad in the S&P 500 and in the NASDAQ as we've seen in the Dow, but certainly it will get your attention. Oil has gone from $54.20 a barrel at the beginning of the year to as low as $27.34. That's a major decline, basically 50%. Gold was $17.04 just last week on the 7th of March. Today it closed at $15.68 an ounce, or down roughly 8%, and that's supposedly a safe asset that people will be moving into. Now, Treasury yields have also come down, but that means that Treasury holders should have some price appreciation. But this has been a precipitous decline. At the beginning of the year, the 10-year Treasury yield was approximately 1.78%. Earlier this week, it traded as low as 40 basis points, which is 0.4% per year. That is a decline of 68.5% in the yield on those securities. What does all of that mean? By the way, as an aside, investment grade corporate bonds, if you look at LQD, which is an ETF that tracks high quality corporate bonds, in just a week, it has lost over 12.5% of its value. To say this is unprecedented, I think is unusual. I think that that's overblown. But a lot of this seems to be because of the panic that's going on because of the pandemic of the coronavirus. Now, what is the coronavirus? I'm certainly no epidemiologist. I'm a financial guy, so I tend to look at things in terms of numbers. If you look at the total number of cases in the United States and worldwide, based on the best information today, this is still not a very large number of people. So remember, stay focused. Try to take the emotion out of this. The summary takeaway is we are watching this very, very closely. Obviously, even conservative portfolios have been hit pretty hard in the last week and today in particular. They may have been holding fixed income instruments that are paying fixed cash flows that actually sold off dramatically today. In my opinion, the baby's been thrown out with the bathwater. And they threw out the bathwater, and then they went next door and grabbed another baby, put it in new bathwater, and threw that out again. We were down another 10% today. So this is serious in the whole scheme of things. We are now priced in the markets basically where we were in the summer of 2017. We also briefly touched this on December 24th of 2018. So this isn't completely unprecedented, but it hurts. It's not fun. When you see your balances and you see the impact that this has had, it has wreaked havoc. Lots of fixed income investors have relied on oil and gas transports for years to pay them dividend yield to live on. Lots of folks have been living on U.S. Treasury yields. As those have sold off, your yields have gone down and the value of your investments have gone down if they're not in treasuries. That's not fun for anybody, for us included. But I want you to really focus on taking the emotion out of this equation to the extent possible. This is a very brief but severe downturn in the markets. Trades that I would be looking at as we come out of this, maybe energy, maybe not. Might be a little early for that. There are some international pressures that are certainly weighing on that. I would not be looking at tourism stocks like cruise lines. I wouldn't be looking at travel stocks like airlines or hotels. Those are liable to feel the impacts of this much longer than the economy overall. When you look to reinvest cash that you might have and you want to put it into the markets, I would look for those high quality growth names that have sold off the most. If you have any questions, let me know. I'm happy to talk to you. This is Brad Harvey with Harvey Investment Management. Thank you.